Very good. Well, good morning and welcome everybody to our webinar this morning. The theme is what's next for the environmental commodity markets. But before we go into that, I think that although there's a number of market participants on this morning, we do also have among us a number of people that for who this is an unfamiliar subject. So for their benefit, I'll just introduce the subject. Environmental or emissions trading schemes, programs are very much a 21st century game. They are the result of various governments and cities and states looking to reduce their greenhouse gas emissions. And in the process of that, trading systems have been set up to facilitate the whole idea of a cap and trade program. The idea is that the carbon emissions from essentially old industry and hydrocarbons will be capped and can be traded off for renewable energy. These programs are in effect in many countries around the world. It's a business that has grown to a turnover of approximately $625 billion a year. There is a bewildering range of acronyms to describe everything, but for the purposes of this morning's meeting, we're principally looking at the renewable fuels markets in the United States and Canada. And in North America, the acronyms are LCFS, which stands for Low Carbon Fuel Standards, principally in California, but also in a number of other states and provinces as well, and RINs, which are Renewable Identification Numbers, which is a US federal program intended to increase the amount of renewable fuels in what we put in our gas tanks. So that I think is from the top of what this market is about. And I'd like now to introduce Jordan Godwin. Jordan is with one of the principal benchmarkers in our industry, the Oil Price Information Service. So without further ado, Jordan.
As you can see in the charts showing our daily price assessments for RINs and LCFS so far in 2020, both markets they experienced a brief dip there in mid-March, but since then they've really generally recovered and have actually experienced relative stability in recent weeks. These are markets that typically see a ton of volatility and wild price swings, so this has been a pretty fascinating phenomenon to have this newfound calm in these markets. So in the RINs chart, what you're looking at is our current year assessments for both D6 renewable fuel RINs, and those are largely generated by corn-based ethanol, and D4 biomass-based diesel RINs. Those are predominantly biodiesel and your renewable diesel. So one of the biggest reasons we've seen this stability is rooted in the way that these programs are designed. Refiners are generally mandated to ensure the blending and consumption of certain levels of biofuels and low carbon fuels to offset their gasoline and diesel output. Regardless of how much demand for motor fuels tumbles, there's really not a ton of flexibility in how these blends hit the market. So as an obligated refiner's output for gasoline and diesel begins to fall off, somewhere around 40% by most measurements that I've seen, so also does their compliance demand under the RFS and LCFS and their need to enter the market and buy these credits. RINs and LCFS credits really react much more strongly to policy outlook than the traditional supply-demand fundamentals. On RINs under the RFS, ever since the biofuels industry won a really key legal battle regarding EPA's implementation of the small refinery exemption waiver program in late January, RINs have really steadily moved higher. they actually hovered at or near 2-year highs for much of April. There was a brief dip there in mid-March around reports that the Trump EPA might try to challenge that 10th Circuit Court decision that has really proven pivotal for RINs prices, but they ultimately passed on appealing. Biofuels proponents believe this ruling should spell the effective end of that SRE program that really wreaked havoc on RINs prices for the last 2 years. There's also another factor keeping RINs under thumb at the moment, and that's growing unrest from the oil industry seeking an RFS waiver in 2020 due to the strain the coronavirus pandemic has put on the industry. The biofuels industry has urged EPA to deny those requests, saying they've also been hit by the pandemic and such a waiver would only make matters worse. So EPA's handling of these requests, as well as how they implement that SRE court ruling, will certainly be worth watching in the coming months because they're highly likely to affect RINs prices. On LCFS prices, they hit an all-time high, as you can see there in early February. That was our all-time high OPIS assessment of $218 per credit. And that was when traders were really trying to figure out the California Air Resources Board and how they would implement these new cost containment measures to the program. The aim of this rulemaking has been to effectively cap prices at $200 per credit and $2016 adjusted for inflation, which in 2020 is $217.97. That rulemaking is expected to go into effect July 1st. We did see a brief tumble there in mid-March around the time California began its stay-at-home orders, but prices have really rebounded since then and have hovered just under $200 per credit. So that's generally the movement we've seen since the beginning of the year at OPIS. And now I'll turn it over to the other panelists to give a little more insight into what these changes have meant and what we might expect to see in the coming months.
So I'm Dave Hackett. I'm the president of Stillwater Associates, and we do transportation energy consulting. Jordan did a great job of explaining, what happened in the LCFS market as far as the prices are concerned. And we think that, so what we see out there in the marketplace is a big drop in production, matching the drop in demand. Let's turn the camera on. There we go.
There you are.
Yeah. So gasoline demand's way off. Diesel demand is off. And as a consequence, the deficits that the refiners would normally be generating is gone down as well. So that's going to have an impact on the LCFS market. Fewer deficits are going to be generated. And really, because gasoline's off more than diesel, the impact on the market will be somewhat skewed because, frankly, in the diesel market is where the bulk of the gains in credit generation have happened. So we think that renewable diesel and biodiesel blending continue at relatively high levels. Actually, when you look at ARB's numbers, you can see that biomass-based diesel, the combination of the two, is about 23% of the diesel pool. And so there's a fair amount of credit generation that will go on because of that. So the diesel segment will contribute more than the gasoline segment will as far as credits are concerned. And so where you see the big impact in light duty vehicle demand will show up as for replacements for gasoline like ethanol or electric vehicles. So turning from the low carbon fuel standard to the renewable fuel standard, this is kind of a primer on all this. And apologies if some of this, you know some of this, but some of you do and some of you don't. But the total RFS is in this box. And there are a number of different components: cellulosic biofuels, biomass-based biofuels, advanced biofuels, and then the total. So there's X amount of cellulosic that needs to be blended, Y amount of biodiesel, biomass-based diesel. the two of those together can all be used to satisfy the advanced biofuels segment of this thing. And so one thing and so there's a lot of biodiesel out there. And so the biodiesel prices trade very close to the D5 prices because most of the biomass-based diesel is used to satisfy the requirement in the advanced biofuels area. And so then what's left over is total renewable fuels, or the D6 RINs, or people talking about them as ethanol RINs. And so once you get into the numbers, what you see is that when a refiner has an obligation, the refiner's obligation is on gasoline plus diesel. So there's an ethanol obligation on their diesel production and a diesel obligation on the gasoline production. And basically what that says is that there's a fair amount of biodiesel out there providing D4 RINs, but with gasoline off, they're going to wind up coming short on covering their D6 obligation. And so our Dr. Adam Schubert put together a little model, and he looked at a simple refinery that produces gasoline and diesel in order to understand why. We were getting questions. Why are D6 RINs so strong and D4 RINs relatively weak? The spread has collapsed. And once you've gone through this incredible table, what you find out is that because the diesel demand drops much less than gasoline, the net effect is to soften the D4 market and shorten the D6 market. And that helps to explain why that spread has narrowed. It doesn't seem obvious until you work through the numbers. You've got an example like this and work through the numbers. So I think that kind of in summary, we see the LCFS market to be relatively soft going forward as people are trying to understand what's going on. But on the long range, the program is going to be short credits going forward. So we expect that LCFS credits will tend to track with the cap. As far as RFS is concerned, Jordan did a good job of explaining some of the political nuances that go into that program. And so we see a lot more political volatility in the renewable fuel standard than we do in the low carbon fuel standard. And Mike, I'll hand the mic back to you.
Okay, thanks, Jordan. That's great. I'd like to now go to Houston, where we'll meet Dane Delahousey. Dane is with Neste, the national oil company of Finland, and a leader in low carbon fuels. Dane. Do we have you, Dane? Yes, I think we do. We should do. Can we turn? Yes, good. Dane, good morning.
Good morning, everyone. So hi, just wanted to talk a little bit, kind of build a little bit on what Jordan said previously, where he was talking about how that these programs are entirely political. And one of the things that I wanted to look at and have a little bit of conversation was, what do we see now in terms of the government's reaction to the industry, in terms of continuing to give their support of the industry or their commitment to these programs in a post-COVID sort of energy crisis. And some of this had to do with the confluence of COVID particularly. Some of it had to do with how that then meshed with the general oil price crash with the, with the crude oil dropping out, and then what does that look like for the markets? What you've seen here recently is several oil either producing governors from oil producing states come out and make requests to the EPA to waive part or all of the RVO volume demand. You saw again recently, yesterday, the day before, Americans for Prosperity came out in the same way. A group of Ohio governors have come out and asked for the same thing. And so you've seen some of that recent saying, and the concept is, hey, look, with these tighter market prices that we as an oil producing company, as a traditional fossil fuel company are experiencing. We would like some additional relief from some of these blending requirements, some of these mandate requirements that goes out there. You'll see that also happening kind of at also as part of the recovery level. As some of the concepts of, are we doing a green recovery? Are we not doing a green recovery? And you're looking at different governments and saying, do we want to put any sort of additional hooks or carrots at the end of some of this? You'll see the same thing happening kind of north of the border up in Canada, where they were coming in, and there's Graham slides on me, that's good, and saying, hey, look, we think that we need to delay some of our carbon targets that we're looking at in terms of a clean fuel standard because of this recovery effort. And I think what's going to be important to continue to monitor in this really short term is how committed the governments, both the national and the subnational governments, remain to putting forward the energy transition. So you'll see, some of the national things kind of balking, and you're kind of wondering what will the EPA do in terms of these RVO requests. Again, my speculation is not much, but again, with the politics being such they are, that's really an unclear thing. You look at some of the subnational ones like California and Oregon, and they've not seemed to blink in that regard. They've seemed to say, look, our program is functioning. We're continuing to move forward with those types of programs, that we're not going to reduce our aspirations in that. But then you look at even in some sub-state governments that have things that aren't necessarily programs in place, but they've got different ways that they want to say, hey, look, we want to promote energy transition either by putting in different sorts of fueling infrastructure capital or different sorts of procurement programs and some of those kinds of things. And as those budgets really get stretched and tightened in response to the COVID response, I think you're going to see a lot less capital, especially particularly at state and sub-state levels, able to be deployed to really look at alternatives to the traditional liquid fuels, different blending and those sorts of things. So I think as you look at the governments, one of the interesting things will be to see, are they going to blink? So far they haven't, despite some fairly strident calls from a lot of different industry to say, hey, look, we might ought to. They haven't not yet blinked yet, but I think that's going to be the next really important thing to continue to stay engaged, to continue to stay monitor, and continue to see what, is this entirely political landscape? Are there going to be any political changes or upheavals that are going to alter and amend that going forward?
Thank you, Dane. That's great. Very helpful.
My name is Graham Noyes. I'm an attorney based in California. My practice focuses on, like my practice to focus not on the computer. There we go. Practices focus on regulatory analysis, particularly California's low carbon fuel standard, to a lesser degree, the renewable fuel standard. Do a lot of work on policy campaigns and CARB rulemakings, and also am the executive director of a nonprofit. Actually, Dane Delahousse, who spoke, is a board member of the Low Carbon Fuels Coalition, and we are dedicated to the support and expansion of low carbon fuel policies. So I'm very bullish on LCFS policies and deeply embedded in working on them. What I wanted to do today in a relatively short time period here is cover sort of the fundamentals in terms of how California's structure is set up and where it's going next, and just give a little bit of a preview here in terms of other program structures that are on the horizon. And note, as these are state level policies, they are really driven by the particulars of the states. I think it was Judge Learned Hand called the states laboratories of democracy, and the way states do things varies quite widely. California is at the extreme end in terms of the size of the state, the complexity of state government, and I think also the willingness of the legislature to empower administrative agencies to really go out and develop policy. And so California's low carbon fuel standard from a statutory perspective initially stood on AB 32, the overall greenhouse gas reduction requirements that were established for California to reduce This dates economy-wide greenhouse gas levels to 1990 levels by 2020. That was actually achieved by 2016. And then the follow-up legislation by Senator Pavley, and Senator Pavley was on the first bill as well, that extended the program, the overall economy-wide program, out to 40% below 1990 levels by 2030. And that is where we stand now, the phase that we're in. And the LCFS is essentially a sub-policy that sits below that on a regulatory front and reduces carbon intensity, specifically in the transportation sector, and is much more modest in its goals in terms of reduction. We're not trying to reduce carbon intensity 40% additional in the next decade here because of how difficult it is to decarbonize that sector. So the process now is for CARB to implement and enforce that policy out there, and we already have a program out to 2030, and we're at the very we actually would have started the rulemaking for the next session here already on April 8th. That workshop was postponed. I expect to see within the next 6 weeks, and maybe a little bit longer if CARB thinks they're going to get people together again, but I'd say within the next 6 weeks, we'll see the kickoff for the workshopping process, and we'll have the informal phase here in 2020. And then we'll move in 2021 to the formal rulemaking process, and the target date for the new program, which will be a revision of the existing program, and may involve an extension of the schedule of reductions, is targeted for January 1st, 2022. All of this is subject to change. And so that's what's on the horizon in California, is a new rulemaking, maybe some new bells and whistles, certainly some refinements, some work on the OPG modeling, some questions as to whether soil carbon and feedstocks are going to be able to play more carbon intensity reduction role than they can now, and really whatever else that CARB is willing to take up in the rulemaking, which remains to be seen. And so be on the lookout for that, but probably nothing in terms of fundamental program change is going to occur there. It's really going to be working around the edges. In terms of policy expansion, we had active bills going in Washington State and New York this year, which were effectively sidelined by the virus, and really all the state legislators are out now, and to the extent they're back, they're not working on anything that's not crisis related, but we do have a high expectation of bills in Washington and New York again next year, and discussions very active in the Midwestern states, less active but possible in the REGI states, and active policy development with renewable bio already active in Brazil, and both Canadian provinces and federal government in development. A point I'd like to make is the broad support we've seen of the low carbon fuel standard policy structure within California businesses across the lot, and that's going to be an essential part of continuing to expand this very effective policy structure going forward. And with that, I'll close, and thank you for the opportunity to speak today.
Thank you very much, Graham. Appreciate that. Hi there, Scott. Scott is in New York. He's with CBL Markets. He's on the trading end of the environmental commodities universe. Scott, what are you seeing?
Yeah, no, thanks for the opportunity to chat with everybody here this morning. It's been a wild few weeks. So I'm not in the transportation fuels space per se. I'm more on the renewable energy certificates, voluntary carbon, and aviation, which does dovetail into some of the fuel products. So CBL Markets is an exchange for environmental commodities. We operate a spot market for renewable energy certificates, voluntary carbon offsets, and recently announced the launch of an exchange for CORSIA eligible voluntary offset units. For the uninitiated, the CORSIA market is the carbon offsetting and reduction scheme for international aviation. So I would say the last 6 months, even heading into early March, we saw quite a lot of fervor in the voluntary carbon market. A little bit of speculation on what was going to be eligible for the aviation market. Since the COVID situation has put the airlines in such a precarious position, there's a lot of uncertainty around what's going to happen with the baseline for the emission reductions. The way that the CORSIA market works is that you create a baseline for international aviation, and then the growth of aviation has to be carbon neutral. So prior to COVID, aviation globally was growing at around 3.5% per year. So the program, which ran through 2035, represented quite a significant demand for voluntary carbon offsets, as well as a price incentive for airlines to invest in aviation fuel procurement that is renewable or sustainably sourced. So in the last few weeks, obviously with airlines being grounded, there's a lot of question about how's that going to impact the baseline. If you look at some of our other markets, renewable energy certificates, very closely correlated with the power markets, which have had to deal with shifts in daytime demand as office buildings are shuttered and people are working more and more from home. You also had some impacts with the broader volatility in the stock market, spilling over to some of the speculative traders that are in the CCA market, which suffered quite a tumble in mid-March. And from what I understand, quite a few of the speculative entities and participants were completely stomped out of that market. So we definitely saw that on our exchange. We run a spot market. That means all bids have to be backed 100% by a physical cash. So there were several, entities that, we saw pulling their cash out of the market. And so I think that was the impact of CCA spilling over into the renewable energy space. Prior to the COVID, you also saw a lot of activity in the ESG side of things. So a lot of corporate announcements from BP, Delta, JetBlue, among others, on carbon neutrality or net zero carbon targets. So it'll be very interesting to see how those commitments, very public and visible, will be honored over the long term. I think that they're a core value, but in the near term, it's a very big challenge. One interesting thing that we did see is 2 weeks ago, Shell just came out with a carbon neutral target post-COVID. So I think that's a good signal to the broader market that these programs are here to stay. So other than that, I'll leave it. So maybe we'll have a little bit of time for some questions.
Yes, we will do, Scott. Thank you. Going now to Toronto, and we have, I think, on the line, Jordan Solomon. Mike. Jordan Solomon. Hi.
Hi, everyone. Can you hear me?
Yes, I think we can.
Fantastic. Yeah, I was talking before when you introduced me, but for some reason it wasn't going through. To everyone on the call, I'm quite sure you can't see my screen. There seems to be some technical difficulty with my being able to join on Zoom. But so I am going to be probably rather quick and very, very descriptive. So I'm Jordan Solomon. I'm the president of EcoStrat. We're probably the redheaded stepchild at this seminar because we fit in not at the really at the front end of the environmental commodity business, in that we're involved in driving the financing of the plants that produce renewable fuels that then generate the paper that most of you trade. So why is that important? It's important because we've been leading for the past 4 years in the United States a large program to develop what are essentially credit ratings parameters and a credit rating system for biomass feedstock. So for those of you on the call, and forgive me if I'm preaching to the choir for some of you, but you know, biomass, of course, is the front-end feedstock that is necessary for the production, of course, of biofuels, bioenergy, biochemicals, and that then result in tradable commodities like RINs and carbon credits, et cetera, et cetera. So functionally, what I'm talking about is wood fiber that gets transformed into a biochemical, or corn stover that can then be produced to a transportation fuel that may then generate a RIN, right? That then becomes an environmental commodity. So the issue with standing up these kind of plants that make the biofuels, the bioenergy, the biochemicals that result in tradable commodities is partially that the capital markets don't understand the feedstock risk. So what they don't understand, they can't quantify. And that results in capital being restricted and expensive to stand up these new plants. So in order to change that, the project that we've been leading under the U.S. Department of Energy in the United States has been to develop a standardized approach that investors and the capital markets can use to quantify feedstock risk. That those standards, and I'd be showing you a slide right now that very clearly explains how they're function, but they're available to download for simplicity's sake and to look at on our website, ecostrat.com/standards. Ecostrat, ECOSTRAT.com/standards. So basically, this has been, as I mentioned before, a development project funded by the U.S. Department of Energy with two of the U.S. Department of Energy's national labs, Los Alamos National Lab and Idaho National Lab, to develop essentially a credit rating system for biomass. It's supported by the largest capital markets group in biomass in North America today, which is composed of 60 members. They're all banks, they're all investors, but to name a few, it's Citibank, it's Scotiabank, it's Goldman Sachs, it's Rabobank, it's some of the bigger insurance companies like Munich Re, and you can see the whole list of all 60 of the capital markets that have been involved in this on that website that I gave you. So why should you care? Well, why should you care as stakeholders and operators and players in the environmental commodities business is that biomass supply chain risk rating is becoming an accredited national standard of both Canada and the United States, meaning that it will shortly become a standard due diligence tool for investors. And this is why you should care. You should care because in order for a supply chain to be rated, there will be an independent agency to certify these AA ratings. It'll be called the Biomass Ratings Agency. And that agency will touch clean fuels projects at the front end, at the financing stage. So that's important because that's where players in the commodity markets, we believe, want to be, right? You want to touch these projects when at their inception point, a year before they're actually operating and generating RINs, et cetera, et cetera. And so the vortex, the touch point for those will be the Biomass Ratings Agency. So with that, I'm going to close. In terms of timing, et cetera, Mike from Parhelion, can be a touch point for the timelines for standing that up. It's not up yet, but we anticipate it'll be up within about a year. So with that, I'm going to close. Thank you.
Thank you very much, Jordan. Appreciate that. So moving from Toronto to Chicago, and Nathan Clark, who is with Incubex. Nathan, are you with us? Yeah, sorry, we're just unmuting you now. Yeah, there you are.
All right, is that better?
Yes, that's much better. And
Okay.
we've got sound but not vision yet.
Oh, okay, I can try to start the video.
There we go.
All right.
Good morning. Hello.
Good morning or afternoon, wherever you are, depending on where you are. I want to make sure you get that video on because this is the first colored shirt I've had on in about 8 weeks. So then I try to impress everybody. Thanks for having us, Mike. As Mike mentioned, I'm with a company called Incubex. We're a small shop. I'm based in Chicago. We are a bit of an incubator, if you will, for exchange-traded products in the environmental markets. We have a partnership with European Energy Exchange in Europe and their subsidiary Nodal Exchange in the U.S. Nodal Exchange is primarily a power trading exchange, and so most of us are former Chicago Climate Exchange executives, which was a voluntary greenhouse gas effort from about 10, 15 years ago. And so in the US, we focus mostly on CCAs and RECs and REGI, and more recently on LCFS and some of the renewable fuels markets. So I'll just talk a little bit about the role that exchanges have played in these markets over the last few weeks or so. The interesting thing about exchanges in times like these is that, the exchanges are fairly staid institutions. You have a few that have been around for a couple hundred years, Chicago Board of Trade and Chicago Mercantile Exchange. And they make for pretty flashy TV sometimes when you look at the people on the, on the floor of the stock exchange, et cetera. But in reality, they usually kind of pretty much hum along without a whole lot of hiccups. But it's times like these when exchanges really can play a real role in stabilizing commodity markets. And so despite the tremendous volatility that we've had over the last couple of months, the exchange model has continued to hold up. We have not seen any disruptions in trading I'm speaking specifically on the environmental commodity side, but more generally as well. Those trades have continued to clear. We haven't had any disruptions in terms of deliveries. Deliveries of environmental products are generally pretty simple. They're just certificates that move from one electronic account to another. So it's not quite as complex as, say, moving corn or ethanol or physical fuel. But in spite of that, we have had no hiccups on that front, thankfully. The volatility, of course, has increased significantly. And as some of the other presenters have mentioned, it does appear that the prices have stabilized a bit over the last couple of weeks. We had a couple weeks there early on where there was exceptionally high volumes, unusually high volumes. But that, in a way, is a good sign. Better to have those high volume days than for the system to seize up and have no volume days. So we'd rather see that than we would see instances where we have to stop the market and pause trading and things like that. There have been some instances of FCMs, as futures commissions merchants, that have had to step in for troubled firms. As I think someone else mentioned earlier, there have been a few firms that have been rumored to go out of business as a result of this. These would be like small trading firms, most likely. And some of the reason for that is because of the margin requirements that FCMs and exchanges have had to put into have had to implement for market participants. So for those that aren't familiar, there is margin has to be put on deposit. It's basically a fraction of what would normally be the required purchase price for a commodity. That has to be put on deposit at your FCM, and additional money has to be put on deposit at the exchange clearing house. And when prices are very volatile, that initial margin goes up. Just to give you an example, we saw CCA, I know we're talking mostly about fuels here, but just for the environmental markets in the US, the most liquid market is probably the California emissions market, California carbon market. So the CCA market went from roughly, call it $18 down to $13 and then back up to $16 over the course of maybe 6 weeks or so. And as a result, the initial margin went from about $150 million all the way up to almost $900 million. So you have over 5 times the amount of money now required to be on deposit at the exchange than you did 8 weeks ago. And so as a result, there are some firms who simply, can't come up with that money if you're a very small firm, a very small trading firm perhaps, and other instances where there are just significant disruptions at firms that have to come up with that cash. Larger firms perhaps that can weather the storm, but obviously it's not easy. And so, but that's all a reflection of the volatility of the market, and that is the way that the system is intended to work. And so, we're thankful that the trading systems have functioned in the way that they have, and that things have been relatively smooth considering the circumstances. In the fuels markets, specifically, and I'm not nearly the expert that many of the folks here on the call are, but I'll just touch quickly on a few things. Obviously, as crude prices have fallen, RBOB has fallen as well, and as a result, RBOB is now cheaper than ethanol, and so we haven't seen that in quite some time, if ever. And so now you have the RIN price actually serving what was sort of its intended purpose, and that is to incentivize blending of ethanol. I guess the main issue there is that because of the reduction in gasoline demand and the subsequent reduction in ethanol blending, you have ethanol plants that are idling and some that are shutting down, and you have increased uncertainty around the 2020 RVO, as was discussed earlier, and some political maneuvering with various governors petitioning to try to help out refiners and whatnot. And because the blending is so low now, there's really, from what I'm told, very few ways that a refiner can reasonably meet the blending requirements that are currently in place. And so there is a great deal of turmoil in those markets currently, and it seems like that is unlike some of the environmental products that have sort of stabilized. Those markets still seem to be in quite a bit of flux. For LCFS, that's a futures product that we listed not too long ago, a little bit earlier this year. And so most of the trading there that we've seen has been primarily in the prompt or near-term months of the contract. Not a lot of trading out the curve currently, and that's probably just a function of the overall uncertainty in the environmental markets as a whole. People kind of try to stick with what's close at the moment, but again, things have held up there. Deals are clearing and credits being transferred. So that's a positive sign. I think that's I'll kind of wrap up my comments there, and then I'll leave it for any questions or anything that other folks might have a little bit later.
Great, thank you very much, Nathan. Very much appreciated. So, In a moment, we'll come to Doug Parker in Washington. But before we do that, there's a couple of questions, several questions that have come in so far. I'd like to just read out one or two of them. You see, going to the questions. A question for Nathan. On Nodal's LCFS futures, are you seeing increased trading further out on the curve? Do you see this market deepening to allow project developers to hedge LCFS price risk using futures, i.e. for more than just a couple of years out?
Well, we've certainly seen, I think prior to the COVID crisis, there was more of that. I think, as I said, just in the most recent weeks, things seem to have pulled back in that market so that, you have more near-term stuff going on. But I will say that the bulk of the interest that I've seen in that contract lately are project developers who are contacting the exchange looking to do longer term deals out the curve to try to secure some of those revenues or to make those projects more bankable by locking in some of that price risk further on out the curve. So yeah, that's an encouraging sign for us, and I think we're going to see more and more of that in the future as this market matures.
Thank you, Nathan. And this is a more broad-based question, so anybody that would like to hazard their opinion here. The question is, if petroleum-based gas and diesel supply in California is being hit harder than the renewable sides due to COVID-19, could CARB opt to increase the stringency of the LCFS CI targets in the upcoming rulemaking? What are the chances of that happening, particularly as it relates to hitting this SB 32 GHG reduction goal? Let's see. Dave Hackett, do you have any thoughts on that?
Well, at this point, it's a little early to tell exactly where the balances are going to wind up. We've forecast for a long time that credit balance would be drawn down over time and essentially go negative, somewhat before 2030. So we're going to have to see how things turn out. It's going to be, right now you can look to the market and see how the market is trading. It's a little softer than it was, but still pretty strong. So I don't think there are any signals out there right now that CARB has to make a change. Down the road, certainly they have the opportunity to change things, and they've done this before in order to make sure that the program stays viable. They've moved the goalposts back and forth in sync with how the market is developing. So at this point, I think we have to wait and see.
Good. Thank you, Dave. I think that does answer the question. We will come back for some more questions. We're running just a little bit long. We have something like 200 registrants on the call today. But I would like now to go to Doug Parker. Doug is in Washington, and he was with the EPA at a time when there were some problems in the market. In particular, a few years ago, there was a spat of fraud claims. Doug, without any further ado, good morning.
Good morning, Mike. I assume you can hear me, and thanks to all the other experts who joined as well. I'm going to come at this from a little bit of a different angle and just give a real quick kind of a few headlines on the enforcement side of the renewable fuel space, which is really the RINs space. As Mike alluded, I'm the former director of EPA's Criminal Investigation Division. I've left there. I'm now with a company, a firm called RPO Strategies. And during my tenure there, I initiated the Renewable Fuels Fraud Task Force, which included EPA, later joined on kind of a case-by-case basis by the IRS, the Secret Service, and the United States Department of Agriculture. And we initiated the process in probably about 2012, when there were strong indications of fraud at the outset of the RFS market, particularly with RFS 1. I think the good news is that the enforcement cases have brought some level of stability to what was a Wild West market, and some level of confidence, particularly in the biodiesel space, which is where the overwhelming bulk of the prosecutions were. I think the couple of takeaways are that if you're in the buying, selling, or providing capital to the companies in that space, due diligence is still a really significant component of your work. The schemes are not particularly complex, but they become more audacious. I think the most recent big one was the Washakie renewable fuels case in Utah, which was recently concluded with a guilty verdicts, as well as some folks who pled guilty, and it was about $1 billion plus fraud scheme related to bogus tax credits that were being claimed. And as I said, the scheme was not particularly complex, but it was audacious in its scope, in that they were generating renewable fuel, and it was being allegedly sent overseas or domestically in the United States, and that renewable fuel miraculously returned to the site and then was reissued as new renewable fuel, and therefore more tax credits. The fact that the individuals were spending, millions of dollars on luxury vehicles and other things were a few of the flags. But my sense is that this is shaken out, the enforcement work has shaken out a good bit of the bad actors. But at the same time, due diligence remains important. And I think moving ahead, what you need to think about is there's going to be a significant growth in the government, and to some degree, competitors using data analytics and other analysis to really identify fraud at an early stage. There's a principle, or at least I should say a goal in the government, to really cut this off at an early stage. And so you're going to see more financial analysts, more money laundering analysis coming into the fore, even at a time when they feel like the market has been somewhat stabilized. I would say that the cop is not fully off the beat. And then lastly, from a political standpoint, one thing to note, which is not an indication necessarily of an increasing concern in the market, is enforcement resources at the federal level have been talked about because there's been a pullback in regulation. But what the EPA, the current EPA, is doing at the leadership level is pushing more enforcement back to the states. But the reality is the renewable fuel standard is not a state delegated program. So resources that were previously focusing on power plants, et cetera, are now have been quote unquote freed up to work on this and other non-delegated programs. So it's kind of a lesser known fact, but I don't think there will be necessarily a resource shortage in going after this type of work. And they're also, frankly, these cases are very appealing to prosecutors. So with that, I'll hit the pause button, Mike, and turn it back to you. Thanks
very much, Doug. Appreciate it. I think we have time for one more question. And it's this. Does the panel have thoughts on shifting the obligated party purchasing hedging strategies under the LCFS in light of how COVID-19 has affected the market? Has disrupted the credit supply-demand balance. I think for this question, Graham Noyes, do you have any thoughts on that? Graham. See if we can bring you in.
Sorry, I had to unmute there.
Yeah, okay, good.
Okay, good. So, I'd say the perspective I would share off the cuff on that is that the stability factor is very important in these programs. So I think the idea of shifting obligated or regulated party status would have a very high bar to making sense. These are complicated programs. They can be improved, but should be done so only when it's clear that it is indeed an improvement. And I again, from an initial response for this, don't see a fundamental market shift that would warrant revisiting kind of a key part of program structure there.
Great. Yeah. Thank you, Graham. I think we got plenty more to talk about for yet another webinar here, but unfortunately, I'm very mindful of the fact that we are running just a little bit long now. I would like to thank everybody that's been involved in this webinar. I think it's worked out well. As I said, we've got about 200 registers today, which must be a very large part of the use of the environmental commodity market. If you would like any further information, please do contact us. The information is there on the screen. We are, just for your information, having a second webinar 2 weeks from today on Thursday, May 14th, and that one will focus on the other side of the environmental commodity market, the carbon market, cap and trade. With that, I thank everybody for being involved, our experts and everybody in the audience, and we will be sending out recordings of this, and thank you all very much for your time. Thanks.
You're welcome. Bye-bye.
Bye.